Good afternoon, and welcome to this half-year episode of our Accounting and Regulatory webcast series for 2022. My name is Tara Kengla, and I will be your host for today's webcast. Today, our main theme is IFRS 9 expected credit losses, the impact of macroeconomic considerations, and sustainability reporting. We continue to operate in challenging times faced with prolonged uncertainty due to overlapping crises, with rising energy prices and sustained supply chain disruptions. But now we are also facing global food insecurity and further political turmoil. The energy crisis triggered by the war in Ukraine is forcing European countries to rethink their dependencies and shift energy policies, and this will have a mixed impact on energy transition. With this backdrop, during the webcast today, Laura Guégan, EY's European Financial Services IFRS leader, will present EY's Q1 ECL benchmark, including exposures to Russia and Ukraine and secondary impacts. Fabienne Lusinger will support this presentation as a key member of our benchmark team. I'm happy to welcome back to our panel Marek Rosecourt, EY's European Chief Economist, to give his perspectives on the benchmark, perspectives on the macroeconomic environment and the outlook. And lastly, a very warm welcome to Yuri Lee, EY's European Sustainability Reporting Leader. There are lots of developments in this space from global, US, and European bodies, and Yuri will give us an update and provide views on what you should be focused on now, given competing priorities. Laura, over to you.
Thanks, Tara. We're very happy to share the results of the 9th edition of our quarterly ECL benchmarking exercise. When we shared the year-end edition back in March, we said we were now at a point where we had a good perspective on how the bank's IFRS 9 models reacted throughout the crisis. But we were still expecting to see the final outcome, that is, whether losses would actually crystallize and to what extent once the effect of support measures has receded. But we will not really have a chance to see the actual ultimate outcome of the pandemic crisis, as in the meantime, as you said, Tara, the war in Ukraine and the new geopolitical and macroeconomic environment have dramatically changed the scene. Reality has shifted again. New vulnerabilities arise as a result of various types of dependencies, rising inflation, and new monetary policies. The provisions built during the past 2 years generally put banks in a better position, but as we will see, the current level of coverage remains highly dependent on massive overlays. So how did Q1 ECL look like? First, we observed an increase in the level of cost of risk compared to 2021, which was a very benign year, with more normal levels of ECL charges. Exposures to Russia were a clear driver in Q1, resulting in higher ECL charge in Italy, France, Germany, and the Netherlands. Stage 3 losses remained low, and stage 1 and 2 losses were mostly driven by Russian exposures. Banks used relatively stable macroeconomic forecasts, but they increased the weight on downside scenarios. And finally, as mentioned, significant overlays were retained. Before we turn to the detailed comparisons, a brief reminder on our sample. It includes 19 European banks selected based on the size of their loan book to customers. The comparisons show Q1 22 in bright yellow next to the full year 2021, 2020, and often also 2019 that we use as a pre-COVID benchmark. The analysis was based on earnings communication with only very few actual IFRS financial statements available in Q1, so more limited information. And for this quarter, we primarily focused on the ECL charge, the impact of Russian exposures, and overlays. Fabienne, can you take us through the first views?
Thank you, Laura. So I will now take you through some of the details from our Q1 benchmarking results, starting with one of our usual overviews, the trend of the ECL charges per quarter, which is included on this in the next slide. And we have split the sample into 2 groups based on the main patterns of ECL charges. This contrasts with 3 main patterns we discussed in our last webcast about the 2021 results. At that time, we identified one group of banks that had significant ECL releases in 2021, a second group that had close to nil charges for the year, and a third group that had more normalized levels of ECL charges. For Q1 this year, we see that the pattern of charges for groups 1 and 2 have largely converged, and this new group is what we show on this current slide. It includes the UK, Dutch, German, Swiss, and Belgian banks. Before we get into the details, another couple of important reminders. First of all, please keep in mind that the yellow bar is only for 1 quarter for this year, as compared to the other bars representing full years. And secondly, the bars represent the amounts booked by the banks. Therefore, the size of the bars is impacted by the size of the banks, and the amounts are presented in respective reporting currencies. Therefore, these first 2 slides are not the best suited to compare results between the banks. But it is interesting to use these slides to compare the trends in ECL amounts quarter over quarter for each bank. And for this first group of banks, they generally had significant ECL charges in 2020, and then either releases or near nil charges in 2021. And we can see that in Q1 2022, their charges are higher than in Q1 in the prior year, which for most of these banks was either a release or a small charge. And in fact, for 8 of the 11 banks shown on the slide now, the Q1 2022 charge is already higher than their total charge for the full year 2021. This is especially true for one of the Dutch banks, which is mainly due to its exposure to Russia, which we'll look into a little bit later in this webcast. On the next slide, we have the second group of banks. So this is the group that we identified in the prior webcast as having a more normalized path of ECL charges, meaning less increases in 2020, but then also a more normal charge in 2021 with no releases. This group is the Spanish, Italian, and French banks in our sample, and it shows the second main pattern for Q1 2022. The charge for this quarter is generally more in line with the charge from Q1 in the prior year. The exceptions to this are one of the Italian banks and, to a lesser extent, one of the French banks, which had a significant increase in their ECL charge compared to the same quarter in last year. As we'll see later in this presentation, this is mainly due to their relatively higher exposure to Russia. Moving on to the next slide. On this slide and the next one should also be familiar to you if you've joined us on earlier webcasts. On these slides, we have translated the P&L impacts into annualized cost of risk ratios. So for Q1 this year, this means multiplying the P&L charge by 4 and then dividing by the underlying gross loans. This view is more relevant if we want to compare the banks to each other. And in these slides, we've also included 2019 results as a reference point. For the first group of banks on the slide now, the pattern that we just discussed is even more visible in this slide, with all the banks showing a higher cost of risk based on annualized Q1 2021-22 numbers as compared to 2021. This is especially true for the UK banks, which had negative cost of risk for 2021. But it is important to remember here that UK banks are not always easy to compare due to some banks having a more UK focus as compared to large international networks of some of the other banks. The pattern of higher cost of risk for the current quarter as compared to prior year is also very visible for one of the Dutch and one of the German banks, which is again due to their cost of risk related to Russia. We will see later on that these 2 banks are among those with the highest exposure to Russia from the banks in this group. However, to put 2022 into historical context, when we compare the white bar with the yellow bar for each bank, we can see that for most of these banks, the annualized cost of risk for Q1 this year is below the cost of risk for 2019. We will look at this again in a few slides where we have mapped the 2022 cost of risk against that of 2019. Now we'll have a look at the cost of risk for the second group on the next slide. The second group of banks had a more normalized trend over the past 2 years. Compared to the first group, these banks had a less pronounced increase in cost of risk for 2020, but also no negative cost of risk in 2021. And for this group, we can see that the annualized cost of risk for Q1 2022 is generally very close to the cost of risk for 2021. Exceptions to this are again those banks that have significant exposure to Russia, which is primarily one of the Italians and one of the French banks. But interestingly, also for this group of banks, the annualized cost of risk for Q1 2022 is generally below or quite close to the cost of risk for 2019. Moving on to the next slide. On this slide, we have the split of the cost of risk between stages 1 and 2 on the one hand and stage 3. Not all the banks disclose this data on a quarterly basis, so the sample of banks shown here has been reduced to those that either disclose this data directly or where we were able to recalculate this. The stage 1 and 2 cost of risk are reflected by the white and the yellow bars, and the stage 3 is in light or dark gray. The slide shows 2 trends in terms of provisioning for stage 1 and 2. Those banks that have a significant exposure to Russia have a significant stage 1 and 2 cost of risk, which is at least partly a reflection of most banks moving their Russian exposures into stage 2 during the quarter. And the other banks tend to have very low stage 1 and 2 cost of risk, or even small releases, as the macroeconomic outlooks, as already mentioned by Laure, have remained fairly stable compared to year-end. Furthermore, as you may remember, in prior webcasts we pointed out that the stage 3 losses during 2021 were quite low, and this trend continued into Q1 2022, with stage 3 losses at historically very low levels. This continues to raise the question whether any losses from the cessation of COVID-19 related support measures will lead to an increase in stage 3 in the future. And on the next slide, we're going to look a little bit more into the exposures of the banks to Russia. There are two graphs on this slide. The graph on the left shows the Q1 2022 annualized cost of risk across all stages, but now split between the part related to exposures to Russia and the remaining part. Important to remember here is this is based on disclosures made by the banks, which are not always done on a fully consistent basis and therefore may not always be comparable. Furthermore, not all banks disclose this data for Q1. Those banks are represented in dark gray in the table. For the banks where we were able to estimate the part of the cost of risk related to Russia, this is represented by the yellow part. You can see that for those banks, the yellow part tends to represent the majority of the cost of risk for the quarter, and Summit is nearly 100% of their cost of risk for Q1. Then in the graph on the right, as mentioned before, we have plotted the Q1 2022 annualized cost of risk on the y-axis against the 2019 cost of risk on the x-axis as a benchmark for a more normal year. The banks are represented by the bubbles, where the bubble size represents the magnitude of the losses related to Russia if this was disclosed. We have also drawn two lines here to enable an easy comparison. The lower of these lines is the par line. This represents a situation where the annualized cost of risk for Q1 2022 is equal to the cost of risk for 2019, and the higher or steeper line represents a doubling of the cost of risk for Q1 2022 compared to 2019. Generally, the graph shows that those banks with the higher losses related to Russia, so the larger bubbles, also have the higher cost of risk for the quarter. Furthermore, the larger bubbles are almost all above the lower trend line, which shows that the higher losses to Russia has meant an increase in the cost of risk as compared to 2019. In contrast, almost all of the small bubbles are below this trend line, representing a decrease in their cost of risk compared to 2019. It is also noteworthy that one of the Italian banks has the largest bubble on this graph, which represents their loss related to Russia at 1.3 billion for the quarter. This was followed by one of the Dutch banks and the other Italian bank at around 800 million each. And to analyze these amounts a little bit further, we have to put this into perspective of the related exposures, which we've included on the next slide. So this slide is a summary of the exposures to Russia. It includes only those banks that have specifically disclosed this. A few things to keep in mind here. The disclosures from the banks are not always on a consistent basis. For example, some banks disclose gross exposures, others disclose modeled exposures, for example, EAD, or exposures net of some guarantees. And secondly, exposures can be split into two types. Firstly, the onshore exposure, meaning at a local subsidiary in Russia. These exposures are in light gray. And in those bars, we've accentuated the equity of the local subsidiary. Secondly, we have the offshore exposures, meaning cross-border exposures. These are represented by the yellow color and include both funded balances and unfunded commitments where disclosed. So this data leads to some interesting insights. It's quite clear on a total level that one of the Italian and one of the French banks have the largest exposure to Russia. However, significant parts of their exposures are onshore. The onshore amounts tend to attract less ECL charges since these are funded locally. And in fact, some banks state that the potential risk on their onshore exposure is generally limited to their equity investment in a subsidiary. Important to keep in mind that a loss of this equity investment triggered by a disposal of the subsidiary would not be reflected in cost of risk. On the other hand, the largest offshore exposures are at one of the Dutch and both of the Italian banks. These are attracting the majority of the ECL charges for Q1 2022, which we saw earlier in some of the graphs. Then on the next slide, we have put this in a bit more global perspective. This slide contains some highlights from an EY analysis based on BIS data for global banking industry exposures to Russia. It is consistent with the results in our analysis, showing that the largest exposures are with the Italian and French banks, followed by Austrian banks. It is interesting to note that the exposures to Russia are less than 2% of the loan books, even for the most exposed banks. And even in a worst-case scenario, the direct effect of loss of such exposures would be a drop in CET1 ratio of less than 1% for all banks. Based on this, regulators' early concerns over the effects of the direct exposure to Russia have largely been eased, and the focus is now on the second order or indirect effects of the situation, which are likely to be broader and will be closely monitored. Now I'll hand off to Laure to go through the rest of the results.
Thanks, Fabien. So let's now focus on overlays, which are the second main drivers for ECL trends in Q1. This graph shows the total amount of overlays disclosed by banks. So Q1 22 in yellow, as usual, next to year-end 21, half-year 21, and finally year-end. And as you can see on the graph, the significant amount of overlays observed at year-end has remained relatively stable. As a reminder, overlays became very significant in 2020 and have continued to increase up until mid-21. They were used for different purposes, adjust the models, unable to predict properly in such unusual circumstances, differentiate the sectors, and also take into account the effect of government support measures with a high level of uncertainty regarding their ultimate effect on defaults. After decreases in the second half of 2021, most banks stabilized their overlays in Q1 with actually two different patterns. Some banks have replaced their COVID overlays with new overlays. Therefore, the total amount is stable, but the allocation has changed. This is typically the case for banks exposed to Russia, which have replaced significant COVID overlays with new overlays related to Russia and/or new macroeconomic uncertainties. But this is also the case for other banks which have replaced a COVID overlay with a new geopolitical overlay. Another group of banks have simply maintained their COVID overlays, considering that the view on uncertainties was broadly unchanged as a result of increased geopolitical uncertainties, rising inflation, and a lag effect still expected on defaults as some support measures just started to roll off. This is generally the case in the UK and in Spain, and only very few banks had a net release on their COVID overlay. If we now look at the proportion that overlays represent in the total stage 1 and 2 ECL allowance, it's also fairly stable and still represents high proportions, around 40 to 70%. Which means that for a number of banks, stage 1 and 2 coverage ratios would be below their 2019 levels without the overlays. And this is because banks have experienced such a benign credit environment during the past periods, and at the same time, the macroeconomic outlook was very positive. The level of overlays also means that most banks do not expect significant increases in their cost of risk for 2022. They generally have revised their outlook slightly upwards compared to year-end, but they still expect a level of cost of risk in line with their through-the-cycle range. An additional dimension to this is the level of stage 2 loans, which is represented on this graph. Note that the percentage is based on stage 1 and 2 exposures only. At year-end, in dark gray, decreases were driven by the improved economic outlook, as well as transfers back to stage 1 for some sectors deemed less vulnerable. In Q1, in bright yellow, the proportion is relatively stable compared to year-end. As Fabien mentioned, Russian exposures were moved to stage 2, but the impact on the total portfolio is generally not that visible. More indirect effects with a more medium-term perspective are not yet reflected in stage 2 classification. In particular, banks highlight that vulnerable sectors have shifted from services sectors to energy-intensive sectors, such as transport, manufacturing, construction, and raw material, and areas of business vulnerable to rising inflation and upwards shifts in interest rates. But this is not yet reflected in stage 2 transfers. These effects are rather covered by overlays. And these more indirect effects have been highlighted and are closely monitored by regulators. In a recent supervision newsletter, the ECB explains that their reaction to the war in Ukraine was first to focus on direct exposures to Russia, but rapidly they identified new drivers of potential asset quality deterioration. Increased costs for corporates in relation to energy, commodities, and other imports, supply chain disruptions, deterioration in market sentiment, and finally, a decrease in households' disposable income caused by unemployment and inflation. There are also new conflict-related vulnerable sectors, commodity trading and energy utility sectors, energy-intensive and raw material-intensive sectors where concentrations are closely monitored, and finally, some COVID-vulnerable sectors which remain under scrutiny, in particular real estate. And model redevelopments, model limitations, and the enduring use of significant overlays are also major areas of focus for supervisors. There is a need to redevelop some models to improve their quality and reflect the latest observations. And for that, model segmentation, PD, and LGD economic drivers have to be reassessed. Models should also be more sensitive to sectorial drivers. But recent events have shown that less reliance can be put on historical data. Therefore, banks need to develop more agile risk approaches involving more judgment to manage the unknown. This means more robust governance and a due process to ensure an objective assessment. And for that, consistency between the estimates used for accounting, risk management, pricing, and ultimately strategic decisions become critical. Finally, as mentioned in our March webcast, supervisors are also closely monitoring the ability of banks to tackle climate-related and environmental transition risks as they become more prominent. With that, I will now turn to Marek to cover the macroeconomic outlook and see what's ahead of us for the coming quarters. Marek, we saw that the macroeconomic outlook banks used in Q1 was that growth would remain positive and projection beyond 2022 were not changed significantly. But what has changed since then, and what will Q2 projections look like?
So Laura, let me first start with where we are in terms of post-pandemic recovery. On this chart, we compare GDP level in various countries in the first quarter this year versus the last quarter of 2019, that is before the pandemic outbreak. And it turns out that despite the detrimental impact of the COVID crisis in the short term, in most European, US, and many advanced economies, the recovery turned out to be much faster than after the global financial crisis. And most economies, including European Union as a whole, as of end of first quarter this year, were already above and sometimes significantly above the pre-pandemic levels. But the performance of the Eurozone economy, as you can see, is actually worse than when compared, for example, to the US economy. And also some European countries have not yet fully recovered, that you see on the right-hand side, especially countries with a significant role of the tourism industry or automotive industry that has been impacted adversely by supply chain disturbances. But this relatively strong recovery has largely been due to a significant progress that has been made to leave the pandemic behind, and withdrawal of containment measures have greatly supported services activity in most economies. However, as we can see, coronavirus is not completely gone, and the recent resurgence of new COVID cases in China that you can see in chart C resulted in further supply chain disruptions and a stronger than projected slowdown in Chinese economy, which will result in an additional drag on global demand. Although latest announcements by the Chinese government indicate more policy measures will be adopted to at least partly offset the adverse impact of spring lockdowns in this country. And as regards the economic outlook, at least until recently, economic recovery in most countries was projected to continue with strong GDP growth rates expected also in the current year. However, economic forecasts are now being revised downward due to the war in Ukraine, already mentioned slowdown in China, also tightening financial conditions, not least due to interest rate hikes by Fed and other major central banks. Still, recession is not a baseline scenario, although technical recession defined as 2 consecutive quarters of negative real GDP growth may happen in some countries. And when we account for most recent shocks, especially the war in Ukraine, unsurprisingly, we see downward revisions of GDP growth projections And on the left-hand side, you can see the chart that presents forecasts for average GDP growth over the years 22-23, where horizontal axis shows projections prepared before the war's outbreak, while vertical axis indicates most recent forecasts. And these GDP outlook revisions have been accompanied by significant increases in inflation projections that you can see on the right-hand side. And generally, stronger upward revisions of inflation forecasts have been made for countries where food and energy account for a relatively large share of consumption baskets. At the same time, the balance of risk to economic outlook is clearly to the downside for GDP growth and to the upside for inflation. And as the drivers of commodity prices now shift from the epidemiological to the geopolitical, they are unlikely to prove easier to forecast.
Thanks, Marek. And similar to the COVID crisis, sectors remain at the center of credit risk analysis. So what are now the key drivers for sector vulnerabilities?
So let me first show which sectors have not yet recovered from the pandemic. And those most severely impacted by the COVID crisis comprise mostly leisure tourism industry affected by lockdowns and decline in consumer demand for such services during the pandemic, as well as automotive industry that you can see also on the right-hand side, suffering the most from supply chain disturbances. And it's also worth to note that these sectors not only account for a larger share of economic activity in Europe when compared to the US, but also in Europe, they contracted more than elsewhere during the pandemic crisis. But fortunately, these are also the sectors that are expected to rebound most strongly in the coming quarters, as the tourism and entertainment sectors are benefiting from the opening of economy and reduced health risk, especially that will be visible during the upcoming holiday season, although these sectors will also be exposed to contracting or slowing down consumer demand as high inflation is eating up household budgets. And there are obviously sectors that are less exposed to the current slowdown or are even benefiting from it. And one prominent example is the energy sector, which is now seeing windfall profits resulting from the increase in commodity and energy prices. And the manufacturing sector, on the other hand, should brace for across-the-board slowdown in demand caused on the one hand by consumers' limited ability to spend in the environment of high inflation, and on the other hand, the rotation in consumption from goods towards services, which will be particularly strong in the US. Moreover, forthcoming, already rising, but even more rising in the coming quarters, food prices combined with energy prices will squeeze households' budget for non-essential goods. And these tendencies will be exacerbated by excess inventories in some industries, where earlier anticipation of product shortages led to precautionary hoarding by companies, which exacerbated supply chain disturbances. And this is particularly the case for many home appliances for which demand surged during the pandemic. And in the case of the automotive industry, we should see some rebound in production when supply bottlenecks recede, but due to the war in Ukraine and the recent lockdowns in China, supply bottlenecks may persist longer, and they may also recur in the future, be it due to further geopolitical tensions or potential new lockdowns in China. Moreover, demand for cars will also be affected by declining disposable income of many households. And I already mentioned rising energy and food prices, which brings us to the impact of the war in Ukraine and also on some sectors. So far, the main channel through which the war has impacted other economies have been large increases in already elevated commodity prices and compounded trade and supply side disruptions. It's also worth to note that while oil accounts for the largest share of Russian exports, Russia's footprint in the global trade is even more significant in the case of other commodities. In particular, Russia and Ukraine are key global exporters of metals, agricultural products, and fertilizers. And as you may see on the right-hand side chart, we constructed an index that shows price changes of those commodities where the combined exports from Russia, Ukraine, and Belarus exceeds 10% of global trade. And it clearly shows that the prices of those commodities since the war's outbreak have increased much more than other commodities, which actually, in their cases, prices have remained relatively stable, while in those impacted by the war, prices are roughly 25% higher on average than in February. And of particular concern in this context are rising food prices that have reached already historical highs and may disproportionately affect emerging markets, where food accounts for a higher share of consumption baskets than in advanced economies. Africa and the Middle East will be strongly affected, given that they used to import a lot of wheat, especially from Ukraine and Russia. And there is thus a high risk of social unrest or even bread riots in countries such as Egypt, which is the biggest global importer of wheat, and almost all of that comes from Ukraine and Russia. And such tensions, if they occur, they may also result in Europe facing massive migration inflows. And in the context of energy prices, it's also worth to note which European sectors are most energy intensive, which is what we show here, with the upper chart listing top 10 most energy intensive sectors in the European Union. Importantly, here we look not only at how much energy a given industry uses directly, which is what the yellow color depicts, but also indirectly, depicted with the gray color, through its upstream supply chain. And the most energy-intensive sectors thus comprise transport, mining, and production of metals and chemicals. However, we should remember that while many of these industries have so far been well-placed due to elevated demand to pass on increased costs onto the customers, in many cases, this ability will be diminishing over coming quarters.
Thanks, Marek. This is really insightful. We also observe that there are different perspectives on the macroeconomic drivers in the US, in the UK, and in the Eurozone, in particular with respect to inflation and unemployment. Can you explain the different macroeconomic trends in the different regions and what the drivers are?
Okay, so let me first stress that the recent supply shocks that we experienced, in particular increase in commodities prices, have, at least in the short term, quite a different impact on various economies. And here we show how the increase in these commodities prices since the war's outbreak can affect trade balances of various countries. On the left-hand side, we see actual beneficiaries of these price increases, who usually comprise net exporters of impacted commodities. And these are mostly energy commodities exporters, such as United Arab Emirates, Saudi Arabia, also Norway, Australia, and Colombia. Interestingly, you can notice that for the US, we can also estimate a net positive impact on trade balance of these commodities price changes. And that stands in stark contrast to many Asian and European economies that you can see on the right-hand side. And these economies are most adversely impacted by current commodity price shocks. Moreover, the European Union is relatively dependent on imports of many energy commodities, but also wood, fertilizers from Russia. And the most important risk for economic outlook in the short term is that of potential sudden stop of natural gas flows from Russia to Europe. So Europe is in a quite different position compared, for example, to the US. So this different exposure of various countries to supply shocks helps explain, at least partly, that while inflation is on the rise in almost every OECD economy, there are significant differences in terms of inflation drivers across countries and regions. Energy is one common factor, and as you can see, it accounts for a majority of inflation increase in the euro area, as depicted with the purple color. And actually in the euro area, inflation turns out to be mostly supply-driven. However, in the US, you can notice that prices of non-energy goods have also increased significantly, driven by consumption boom, fueled with extremely strong fiscal stimulus, coupled with supply disturbances. You can also see a pretty strong acceleration in services prices in the US on the back of an earlier increase in house prices, but also elevated wage growth, because in the US, labor market is much, much tighter than in the euro area. And on the right-hand side, you can see inflation drivers in the Central and Eastern European countries, where again, energy prices play a very important role, but we can also see a pretty strong contribution of prices of non-energy goods and also services inflation that has been in the upward trend for many years and recently accelerated even more. So, and these charts on the next slide, they just confirm and illustrate different inflation drivers in individual countries, showing that in the Eurozone, inflation is less broad-based and driven by a fewer number of factors than, for example, in the US, UK, or especially in the Central and Eastern European economies, where along supply shocks, also strong domestic demand fuels inflation, which is not so much the case in the Eurozone. In fact, until recently in the euro area, inflation was driven predominantly by energy prices, so it was expected to get back quickly to the ECB target as the energy shocks recede. However, after the outbreak of the war in Ukraine, it is not likely to happen in the short term. And a very short comment on the UK, where inflation, as you can notice, is strongly affected by rising prices of tradable goods, for which the UK is essentially a price taker. Moreover, as I will also show on the next slide, consumer demand in the UK is supported with a continuing tightening in the labor market. And inflation in the UK is projected to exceed 10% in the last quarter this year, mostly due to further increase in household energy prices following the large rise in the Ofgem price cap. Actually, the last revision was in April, and the next is forthcoming in October, which delays the impact of energy shocks on the retail energy prices in the UK. So as a result, inflation is likely to peak later in the UK than in many other economies. But the critical factor for inflation outlook and thus monetary policy are labor market developments. In particular, price pressures could become stronger and more persistent if they feed through into de-anchoring of inflation expectations and higher wage rises. However, unemployment rates, as you can see in the bottom chart, and other measures of labor market slack, for example, underutilized available labor force that you can see in the upper chart, these measures vary significantly among countries, and so does the risk of accelerated wage growth. In particular, you can notice that there is larger amount of slack in southern European countries, including Spain, Italy, Greece, but also France, while, for example, in the UK, US, or Central European economies, this slack is much, much lower, and labor market is much tighter when compared to Eurozone economies. And these differences in labor slack are largely reflected in different wage growth rates that you can see on this chart on the left-hand side, where nominal wage growths are very high for Central European economies. They're also relatively high for the US and UK, while in the euro area countries, especially in the south, the wage growth remains muted. So, and you can see also on the right-hand side, the most recent annual growth rates in wages. You can see a significant acceleration in that growth in the US, UK, while in the euro area, again, it turns out that wage growth still remains muted. But even in the euro area, persistent supply shocks and rising costs have been passed on also to prices of other products, resulting in inflation getting more and more broad-based. And here on this chart, we show the share of categories in the euro area consumption baskets with an annual price growth exceeding 3%, yellow line, 5%, light gray line, and 10%. depicted with a dark gray line. So you can also see that inflation is getting more and more broad-based also in the euro area. So this actually also has been reflected in the most recent revisions of the ECB projections, according to which, for the second time ever, inflation is to remain above the ECB target of 2% over the whole projection horizon that you can see in the middle chart, and which actually reflects a pretty significant upward revisions of inflation projections relative to previous forecasting rounds, so that you can actually see on these charts. And that actually occurred despite downward revision of GDP outlook, both in 22 and 2023, that you can see in the chart on the left-hand side.
Thanks, Marek. Last question. What about the monetary policies? How may they change the dial? And do you expect some divergence between regions and economies?
Yeah, definitely. In normal circumstances, many central banks would either not respond to adverse supply shocks or even ease monetary policy to mitigate the impact of the war on economic growth. However, the current environment of very high inflation brings additional challenges, since there is a growing risk of increased inflation expectations that could lead to wage price spiral. So as a result, many central banks have accelerated monetary policy tightening, including most recent hikes by Fed. And here we show expected interest rates of the major central banks, including how they have changed since the war's outbreak. Gray color stands for the expectations in the period preceding the war's outbreak, while the yellow lines depict more recent market expectations. And in the case of the ECB, the first hike of 25 basis points is expected in July, to be followed with likely 50 basis points increase in September, and maybe another 25 basis points hikes till the end of this year. In my view, however, markets may overestimate the number and size of ECB rate hikes in 2023 due to what I have already discussed, the fact that Eurozone inflation isn't as broad-based as in the US and is mostly driven by energy prices. Moreover, given more adverse impact of the war on the real activity in Europe and much more contained demand and lower labor market pressures, I also add to that the risk of too strong an increase in Italian government bond yields, which may also increase tensions in terms of fiscal stability. So altogether, that indicates that the scale of the tightening by the ECB should be expected to be much smaller than in the case of Fed policy, where rates may actually reach 3.25 or even 3.5% at the turn of the year, with at least 50 basis points, but I believe it's increasingly likely 75 basis points hike in the next meeting. And UK is also affected by adverse supply shocks, but at the same time, there is a continuing tightening in the labor market. Wages are growing at stronger rates than would normally be deemed consistent with the inflation target, and business confidence still is resilient. So in this context, Bank of England needs to ensure that domestic price setting does not achieve a self-sustaining, expectationally driven momentum, which would maintain inflation at elevated levels even after economic slowdown. At the same time, it's expected that rises in energy prices and also in tradable goods prices will impact UK households' real incomes and companies' profit margins more severely than in the US, which is one of the reasons why the scale of tightening by the Bank of England should be lower than in the case of the Fed. So an inflation in the UK is projected to fall to a little maybe above Bank of England 2% target in 2 years' time and to below 1.5% in 3 years. But again, the balance of risk is tilted towards inflation proving stronger and more persistent. As for outlook and the balance of risks, many claimed, that peak of inflation should be recorded in the second or third quarter. I would say in the UK it will be the last quarter this year. I would say maybe, but again, balance of risks is clearly to the upside for inflation, since there is a significant risk of additional sanctions, including sudden stop of natural gas flows from Russia in winter. Services prices will most likely increase significantly during the holiday season. Food prices will surge in the second half of this year, driven by adverse supply shocks. In countries where labor markets remain tight, the risk of wage price spiral remains high. Fed, also to the extent that there is monetary policy divergence that leads to appreciation of the US dollar, that would make commodity prices expressed in non-USD currencies even higher in European economies. We should also not forget about the fact that pandemic is not over. Potential new waves of COVID and zero tolerance policy in China especially could lead to further supply disruptions and increase in prices. We also should not forget about increasing government interventions that may introduce additional volatility. Sometimes these interventions are in the form of fiscal transfers, supporting demand and protecting consumers from increasing costs, especially energy costs. But at the same time, we see an increasing number of examples where governments regulate also other businesses, introducing different price caps that can also impact the way businesses are conducted. While still most of these disruptions should fade out by the first half of the next year, but I would expect there would be continued volatility for many years. However, maybe not at the level we experience currently, but at the level definitely exceeding what we experienced before the pandemic's outbreak. And while in the long term, we could actually hope for the outcome of this transition, acceleration of transition towards resilience, including energy transition, supply chain diversification, digital transformation. Central European countries benefiting from nearshoring because they will benefit from the fact that they are NATO and EU members, which now will be an important factor in company strategies focus on diversification of supply chains. Still, in this transitory period, we could expect some regionalization of the global trade, informal geopolitical blocks, which at the time of global synchronized acceleration of demand for commodities and many different resources that are needed for transformation, this can actually lead to further supply constraints and disruptions that could lead to recurring shocks, increased volatility, and elevated prices and costs during that period, which calls for transformation and improved efficiency of many companies in different sectors.
Okay, thanks so much. Thanks very much for your perspectives, Marek. There was really good insights in these really unprecedented times. Now we're going to shift gears a bit and move to the sustainability section of the webcast. In these webcasts, we're trying to ensure we make the relevant links between accounting and reporting and climate. Last time we covered the impact of climate risk on ECL, and today Yuri will cover the updates on sustainability reporting. Yuri?
Thank you, Tara. Yes, so as you mentioned, in the previous webcast, we discussed some of the potential impacts of climate change on expected credit losses. But of course, climate change has a much wider and perhaps profound impact on how corporate reporting will evolve in the near future. And in fact, it's not just climate change that has an impact on how the reporting landscape changes, but a whole host of environmental, social, and governance, or ESG topics will affect the landscape. Investors and stakeholders are now also starting to require greater transparency on topics such as biodiversity, diversity and inclusion, or human rights in supply chains, just to name a few. This demand for greater transparency has clearly also been recognized by quite an overwhelming number of international bodies and regulators. On the screen, you see just a selection of these that already have or have planned to put in place ESG disclosure requirements. And it's really quite universal what you see. Something that started maybe relatively small in Europe and the United Kingdom has really also been transformed to other regions, such as the United States. Note that Asia is not in this map and it's covered by this gray box, but there's also very similar movements in that region. So I guess the difficult part now is how to keep up with all the new reporting requirements, especially if you work in a multi-jurisdictional organization where you're subject to a number of regulations that sometimes conflict. The good news, though, is that there are quite a few common threads that overlap throughout the requirements in different jurisdictions. And I'll tell you a bit more about these in a minute. But you have to be aware of all of these different emerging requirements. So on the previous slide, you saw quite a large number of abbreviations presented on the screen. What you see here on the screen is a bit of a different representation of these. when you look on the left-hand side of the table, on the column, you'll see some standards guidelines that may ring familiar to some of you. These are in essence reporting standards, so they'll tell you what and how to report, for example, on the topic of climate change. But on their own, they're not quite yet enforced by regulations. At the top row, you'll see a few key regulations in 3 key jurisdictions, which then start enforcing some of these standards and guidelines. The dots you see indicate when they have referenced, when the regulations have referenced these specific standards or guidelines. Now, what I want to focus on in the next 10 minutes or so is our 3 key ones that you saw highlighted. These are currently out for consultation and which follow very similar consultation implementation timelines. The first one are the SEC proposals on climate-related disclosures out of the United States. These have been heavily been influenced by a framework called the Recommendations by the Task Force on Climate-Related Financial Disclosures, or TCFD. This is originally a voluntary framework, but has already been made mandatory to a large number of firms in the UK, for example. The second one that I want to focus on is the standards proposed by the International Sustainability Standards Board, or ISSB. The ISSB is a body set up to work alongside the IASB under the IFRS Foundation, and they have just published exposure drafts of IFRS sustainability reporting standards. The third one are the ESRS, European Sustainability Reporting Standards. These are published by EFRAG. These will apply to entities that are subject to the Corporate Sustainability Reporting Directive. These are certain European entities from next year, 2023. These cover a whole wide range of ESG topics that I covered before. So before I go on to each of these in a little bit of more detail, as I mentioned, all of these standards are currently out for consultation. And I wanted to start with a poll. So the question is, to which of these are you or your organization planning to respond? To which of these consultations are you planning to respond? We do not intend to respond. The ISSB, the consultation by the European Financial Reporting Advisory Group, or the EFRAG, the consultation on climate-related disclosures by the SEC, or, I don't know, undecided. I'll give it a few minutes. All right. Thank you. So what we'll see, quite an even split between the different consultation currently ongoing, but a large number of attendees currently are undecided or don't know. So if we take these 3, that the 3 ones that are currently out for consultation, and compare these to the TCFD, I wanted to highlight a few key differences and overlaps between them that are worth noting whilst you're drafting your response or even forming your own opinion on them. The first one is the concept of materiality, or what does it mean for a topic to become material for an organization to disclose? The ISSB and SEC revolve their requirements around enterprise value, i.e., a disclosure becomes material if the matter has an impact on the enterprise value of an issuer. However, in contrast to this, the European Union has taken a different approach. They focus on the concept, what they call double materiality. It means not only do they look at the enterprise value, but also the impact a company might have on wider stakeholders, the environment or society. To bring this to life, for example, if we take the concept of climate change, the ISSB then primarily cares about what the future impact might be of climate change on the business resilience. The European Union, however, also wants you to demonstrate how you safeguard essentially our planet, right? How you safeguard our environment and prevent climate change from happening. The second point I want to draw out, and this is a very important one, is the need to disclose Scope 3 greenhouse gas emissions. Now, I don't go into detail what greenhouse gas emissions all entails, but what that means for banks, it essentially means that there's a need to disclose the greenhouse gas emissions from your loan book, from all of your counterparties. To collect this information and report this information is obviously quite an extensive exercise to undertake and is riddled with judgments and estimates given the limited data availability from counterparties itself. The ISSB and the European Union consultations both refer to these, whereas the SEC makes it required only if deemed material. The third one I wanted to highlight is the location of disclosures. All of them will want you to disclose your information into the annual report. However, the SEC also requires disclosure of some elements in the notes to the financial statements, in particular if it's expected that they have an impact to the of a financial statement line item of more than 1%. I'll go in a bit more detail about it in a second. So let me really briefly go through these one by one. So the first one is the ESRS. This will apply from financial year 23 for companies that meet two of the following criteria. It's more than 250 employees, more than 40 million of turnover, or more than 20 million of total assets, and it will apply to all listed companies. So this is quite a vast scope, and it's expected, therefore, it will apply to close to 50,000 companies. As I mentioned, the key differentiator of the European proposals is the concept of materiality, but it also covers a really wide range of different topics, ranging from water and marine resources, biodiversity and ecosystems, but also, for example, local communities. For each of these topics, it requires companies to disclose a narrative, so qualitative information, as well as a set of metrics. For example, if you look at resources and circular economy, standard E5, it requires the amount in both in absolute and percentage terms of reused, recycled, and renewable input materials used to manufacture the undertaking's primary product and services. Another thing to note is that there's a requirement for all of these disclosures to be assured, initially under limited assurance, but ultimately under reasonable assurance. The second one that we covered are the ISSB standards. Each of these, the ISSB has published two exposure drafts, like I mentioned, S1, general requirements, and S2 on climate change. Each of these broadly sets out disclosure requirements in four broad categories that very much align to the TCFD recommendations. Metrics and targets, so how is climate change, for example, or sustainability embedded into, what kind of metrics and targets do you use to measure it? How is it embedded in your risk management? How is it embedded in your corporate strategy? And how is it embedded within your corporate governance? For S2 on climate-related disclosure, there are also industry-specific metrics in an appendix. For this includes metrics such as the financed emissions that I covered before. The last one is by the SEC, is very similar, but it proposes a number of things that are quite unique over and beyond the ISSB one. The first one I kind of already covered is the financial statement footnote disclosures. So it requires the impact on financial statement line items related to severe weather events and other natural conditions if it exceeds 1%. And it also requires expenditures related to mitigating the risk of severe weather events and other natural conditions if it exceeds more than 1%. As mentioned before, it requires the disclosure of Scope 3 emissions if there are certain targets or if it's deemed material. Similar to the European proposals, this is subject to external assurance in a phased timeline as presented here on the screen. So I now went to all three consultations. Companies need to prepare for all of these, and sometimes it's hard to find the bandwidth to understand how to respond to all of these. So hopefully I've given you a helpful overview that helps you prioritize this. I'll now hand over back to Tara.
I think we can do your last polling question, Yuri. I can wrap up in 30 seconds. So should we go to the last polling question?
All right. So the last polling question is, which function in your organization is responsible for sustainability reporting? And we wanted to ask this question because obviously there's a lot of movement and there's a lot more requirements expected in the very near future. And as I mentioned, it's sometimes hard to find the available bandwidth and to understand who is taking ownership of these, especially as many of these disclosures are now going to be required in the annual report. So is this finance, sustainability, risk, or I don't know, or other?
Should we go to the results? Then we can wrap it up.
Yep. So about an even split between finance and sustainability. And I think historically quite often these disclosures sat with sustainability functions. And what we've certainly observed is a much deeper involvement of finance functions going forward. Tara?
Okay, thank you, Yuri. It was really great. I think it was a great overview. And I just wanted to first quickly thank all of our other speakers, Laure, Fabienne, Marek. You gave the audience a lot to think about as we head into half year. Next webcast in September. Just wanted to thank you all for your participation today. And this concludes our webcast. Thank you.